Are you about to miss a withdrawal deadline that could cost you $1 out of every $4 you should have taken? If you just turned 73, the IRS now requires you to pull money from your retirement accounts every single year. Miss one, and the penalty is 25% of what you should have withdrawn. Last year, nearly 7% of retirees at RMD age missed theirs. A billion-dollar mistake. And the biggest trap? The April 1st deadline that forces 2 withdrawals into 1 year. These are required minimum distributions. The government mandates withdrawals starting at 73. Miss it, and you pay 25%. But the worst mistake lurks in year 1. A deadline quirk that forces 2 withdrawals in the same year, triggering a surprise tax bomb. Millions of accounts fall into this trap, so let's deconstruct it. Here is how the trap works. For decades, you deferred taxes on your retirement savings. The government gave you a break, but they want their cut, eventually. At 72, they used to say, time to start taking money out. Now it's 73, and for anyone born after 1959, it'll be 75. But no matter your age, the rule is the same. Every year, by December 31st, you must withdraw a specific amount, fail. And the IRS hits you with a penalty that used to be 50%, half of what you should have taken. That was brutal. In 2023, they cut it to 25%. And if you fix it fast and fill out Form 5329, they'll reduce it to 10%. But even 10% is a bite. And here is the problem. A lot of people simply forget. Vanguard just published a study. 6.7% of investors at RMD age missed their withdrawal in 2024. The average missed amount? $11,600. That's a potential penalty of $2,900. Add up all those missed RMDs across the country, and you are looking at a billion-dollar mistake every single year. The biggest risk isn't just the penalty. It's the forgotten accounts, old 401ks from a job you left a decade ago. A rollover IRA you never consolidated. The IRS requires you to calculate the RMD separately for each account. If you have 3 scattered accounts, you need 3 RMDs. Miss one, and you are on the hook. And the first-year rule makes it worse. You can delay your very first RMD until April 1st of the year after you turn 73. Sounds generous, right? But it's a trap. If you delay, you must take your second RMD by December 31st of that same year. That means 2 fully taxable distributions in 1 year. For someone like Barbara, who just turned 73 and has a 401k from her old employer, a rollover IRA, and a small brokerage IRA, the math can explode. She's about to walk right into it, and she's not alone. What she doesn't know will cost her thousands, and it starts with that April 1st deadline. Barbara retired at 66. She rolled her 401k into an IRA, but never touched the smaller 401k from her previous job. Some $22,000 sitting there for years. And she opened a brokerage IRA a while back. 3 accounts scattered. She's healthy, not thinking about mandatory withdrawals. Then she turns 73 in March. Her birthday triggers a countdown. The first RMD deadline is April 1st of the following year. So Barbara has until April 1st, 2025 to take her 73-year RMD. She thinks, I've got time. She waits. She takes that first withdrawal in February 2025, about $6,000 based on her combined balances. So far, fine. But here's where the trap snaps shut. Because now, in the very same calendar year, she must take her second RMD, the one for age 74, by December 31st. That's another $6,500. 2 withdrawals, 1 year. $12,500 added to her taxable income. She doesn't realize this pushes her from the 22% bracket into the 24% bracket, maybe higher. Her Social Security, which was partly tax-free, now becomes 85% taxable. And because her modified adjusted gross income crosses a threshold, her Medicare Part B and Part D premiums jump. That's the Income-Related Monthly Adjustment Amount, or IRMAA. An extra $60 to $70 a month, maybe more. Multiply that by 12 months, plus the extra tax on the RMDs, plus the Social Security tax spike. It's thousands of dollars gone, all because of a timing rule she never saw coming. But the penalty risk itself is even sharper. Barbara's forgotten $401K. That $22,000 sits with a custodian she hasn't contacted in years. The RMD for that account alone is around $800. It's easy to miss. The custodian sends letters, but she moved and didn't update her address. The deadline passes. The IRS calculates a 25% penalty on the missed $200. Not huge, but if she misses it across all 3 accounts, or if she forgets entirely for the year, the penalty could be thousands. And the worst part? Many people don't even know they missed it until the IRS sends a notice a year later, with interest. The Vanguard data reveals exactly who gets hit hardest. Investors with balances under $5,000 missed their RMD at a staggering 56.8% rate. Why? Because those small accounts are forgotten. Old 401Ks from jobs that lasted 2 years, tiny IRAs from a brief savings phase. Individually, the RMDs are small, maybe $100, $200, but the penalty rate is the same 25% across 8.7 million IRA owners at RMD age. That's potentially over 500,000 missed RMDs each year, generating penalties upwards of $1.7 billion. And the IRS has made it clear, "I forgot" is not an excuse, but they will cut the penalty to 10% if you act fast and file Form 5329 with a letter of explanation. What does that form require? You must admit the error, explain why it happened, reasonable cause like illness, death in the family, incorrect advice, and show proof you corrected it by taking the missed distribution. The 10% rate is a mercy, but the paperwork and stress are real. And if you don't catch it within 2 years, the full 25% sticks. But the tax bracket surge from the first year double withdrawal is the quiet killer. Financial advisors call it the valley of death for new RMD recipients. Retirees who carefully planned their tax bracket suddenly see their rate climb, their deductions phase out, and their Medicare costs inflate. The worst part, it's entirely avoidable. If Barbara had taken her first RMD by December 31st of the year she turned 73, not April of the next year, she would have only one distribution that first year. That one decision, which no one told her about, could have saved her thousands. And there's another twist. If you're still working at 73 and have a 401k with your current employer, you may be able to delay RMDs from that account until you actually retire. But that exception doesn't apply to IRAs or old 401ks. So you could have one account that's deferred and another that's not. And if you miss that distinction, you're in penalty territory again. This complexity is exactly why Barbara's story is not unique. It's the norm for millions, and the government, even as it raised the RMD age, made no effort to simplify the rules or consolidate notification. You get a letter from each custodian, if you're lucky, in small print that doesn't scream penalty risk. And so the billion-dollar mistake continues, year after year, funded by ordinary retirees who simply didn't know the trap existed. But there is a way out, a simple checklist that strips this down to 3 steps, removing the guesswork and protecting your money. That's next. But before we get to that checklist, you need to understand just how deep this problem goes, because it doesn't stop at taxes. The Medicare premium surcharge, IRMA, is a cliff, not a slope. Cross the income threshold by a single dollar, and your premiums leap. In 2025, if your modified adjusted gross income exceeds $106,000 for an individual, you pay an extra $59 a month for Part B, plus an extra $15 for Part D. Go over $133,000, and the surcharge doubles. Barbara's double withdrawal shot her income from $94,000 to over $107,000. That single dollar over the line cost her nearly $900 in extra premiums that year. And the IRS bases RMD on your income from 2 years prior. So, the damage echoes forward. A mistake in 2025 raises her Medicare costs in 2027. She's paying for a timing error long after she's fixed it. And here is the part that makes it truly cruel. IRMA thresholds are not adjusted for inflation. So every year, more retirees drift into surcharge territory even without an RMD mistake. Add an unnecessary double withdrawal, and you are pushed over by accident. Couples with modest pensions and Social Security are especially vulnerable. The Social Security Administration estimates that about 7% of Part B enrollees pay IRMA, but that number is climbing fast. And if you think you'll just appeal, you should know that the only qualifying life events for an IOMA appeal are things like marriage, divorce, death of a spouse, work reduction, or loss of pension. A voluntary RMD timing decision does not qualify. So you are stuck. The forgotten account epidemic is even worse than the statistics suggest. A study by the Government Accountability Office found that millions of Americans have multiple 401k accounts spread across former employers. A quarter of workers who changed jobs left behind an account. The average balance of those orphaned 401ks is around $7,000. That's exactly the range where RMDs are small enough to overlook, but the penalty stings. And here is the kicker. Even if you remember the account, calculating the RMD isn't always straightforward. The IRS life expectancy divisor is different if your spouse is more than 10 years younger and is your sole beneficiary. That's a nuance that many plan custodians don't catch automatically. And if the custodian errs and underreports your RMD, the liability is still yours. The IRS doesn't care what the statement said. You owe the correct amount, penalty and all. Wait, it gets even bigger. The penalty structure isn't just a flat 25% on the missed amount. The excise tax is calculated per account per year. So, if you missed RMDs from 3 different IRAs that you failed to aggregate correctly, you could owe a penalty on each one individually. And if you miss the same RMD 2 years in a row, 2 separate penalties. The IRS can also apply interest on underpayments from the date the RMD was due. So a $2,000 penalty from a missed $8,000 RMD can grow to $2,300 by the time you pay it if the IRS doesn't catch it immediately. But perhaps the most alarming twist is that many people who hire financial advisors still fall into the trap. Advisors often manage only the assets you bring them. If you never mention the old 401k from a job 20 years ago, or the small brokerage IRA you opened yourself, they can't help you. A survey by Fidelity found that 1 in 5 advised clients had at least one external account the advisor didn't know about. And if you've moved, if the custodian lost track of you, your account could be flagged as abandoned and escheated to the state. Then you are not just dealing with RMD penalties, you are dealing with reclaiming your own money from a state unclaimed property office, a process that can take years. The irony is that this entire system was designed to force retirement savings to be used for retirement, and the penalty was meant to ensure compliance. Instead, it's become a hidden tax on the disorganized, the modest savers, and the people who can least afford to wade through IRS bureaucracy. The billion-dollar mistake isn't just a statistic. It's Barbara, who delayed her first withdrawal because no one told her about the 2 distribution trap. It's the widow who forgot her husband's old workplace plan. It's the auto worker who retired at 65 and never touched his small IRA until the IRS sent a notice when he was 74. The fix sounds complicated, but it's not. It comes down to 3 simple actions, a calendar date, and a tracking sheet that anyone can fill out in 10 minutes. And if you are 73 or approaching it, the next few minutes could save you thousands. Here is how to do it. Step 1 is account consolidation. Go find every retirement account you've ever opened. Old 401ks from previous employers, rollover IRAs, brokerage IRAs, SEP IRAs. Write them down. If you are not sure where to look, check old pay stubs, tax returns, and the National Registry of Unclaimed Retirement Benefits. Once you've identified them, you have a choice. You can consolidate them into one IRA through a direct transfer, or you can keep them separate but track them all. Consolidation makes RMD calculation far simpler, but even if you keep them apart, you now have a complete map. Step 2 is the calculation. The IRS provides a uniform lifetime table. For a 73-year-old, the distribution period is 26.5. You take each account's balance as of December 31st of the prior year and divide by that number. If your spouse is more than 10 years younger and is your sole beneficiary, you use a different table, the Joint Life Expectancy Table, which gives a higher divisor and a lower RMD. But here is the key. For IRAs, you can aggregate the RMDs. You don't have to take a separate distribution from each IRA. You can sum up all your IRA RMDs and withdraw the total from just one account. That means if you have 3 IRAs, you can take the entire combined RMD from the one with the most convenient investment. This is the detail most people never learn, and it removes the excuse of forgetting a small account. For 401ks, however, you cannot aggregate. Each 401k RMD must come from that specific account. That's why consolidating old workplace plans into a single IRA before RMDs begin is nearly always the smarter move. A direct rollover is tax-free and eliminates the risk of a forgotten 401k RMD entirely. Step 3 is automation. Once you've calculated your RMD for the year, set up an automatic distribution from your IRA, or 401k for early December, not December 31st, because custodians get swamped, and a processing delay means you'll miss the deadline. Schedule it for the first week of December. Better yet, if you are turning 73, take your first RMD in the year you turn 73 by December 31st, not April 1st of the next year. Avoid the double withdrawal trap entirely. Set a calendar reminder every year for October 1st to start the process. Confirm your account balances, recalculate, and schedule the distribution. Now, Barbara caught her error in time. She realized in March of her first RMD year that she had 3 accounts and hadn't consolidated. She took her first RMD in the same calendar year. No double withdrawal. She consolidated the old 401k into her main IRA, pinpointed her total RMD, automated it, and never paid a penalty. In fact, she discovered she'd been overpaying fees on that forgotten 401k for years. Consolidation saved her hundreds annually in administrative costs alone. The final surprising detail: if you do miss an RMD, the penalty isn't automatic. The IRS doesn't bill you instantly. They expect you to self-report the error on Form 5329, explain the reasonable cause, and request a waiver. And the IRS grants those waivers generously. Some tax professionals report success rates over 90% when the mistake was genuine and corrected quickly. That means you can often reduce the penalty to 0, not just 10%, by taking the missed RMD and sending a simple letter. The IRS isn't hunting for victims, they're enforcing a rule, but they also understand that the system is complex. Use that to your advantage. The real cost of this trap isn't the penalty, though. It's the years of unnecessary stress, the surprise tax bills, and the permanent Medicare premium jump. Those are the things you prevent by acting now. So, before you go, there's one more tool you need. A tracking sheet that makes this entire process impossible to mess up. I'll show you exactly how to get it. That tracking sheet is linked in the description. An RMD tracker by account that does the math for you, gives you the precise date to act, and flags the double withdrawal window. Most people never think about this until a penalty notice arrives. But now you know, and you can beat it by a wide margin. The system isn't going to simplify itself, and the IRS won't send you a polite reminder with a highlighted summary of your lost accounts. You have to own it. And here is the deeper truth. Retirement security isn't just about how much you saved. It's about how well you protect what you built. A single missed deadline can undo years of careful planning. Not because you were reckless, but because you weren't told. The rules exist in plain sight, but they're hidden in dense language, scattered across custodians, and never explained in a single place until now. If this content made sense to you, go to the first pinned comment right now. There's a special offer through that link. Something I've put together specifically for people who want to stay ahead of these traps without digging through IRS publications. Like this video if it helped, subscribe so you don't miss the next deep dive, and share it with someone turning 73. Because the best penalty is the one you never pay.